Welcome to Trade the Trend, a weekly video about where the stock market is heading. This video is going to focus on the SP 500. I'm going to come back and cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only, doesn't take your personal situation into account. With all that said, let's get into the first chart. So I've got the S&P 500, and this is shaping up as a really interesting week. Do we have a new advance underway, or is this going to be a final push higher before we get some sort of a pullback back into the trading range which had prevailed over the last couple of months? So I'm going to go through some charts in a moment. We're going to look at some of the positives as well as a couple of cautionary things to be aware of. But first, let's just have a look at this S&P 500 chart. So new all-time high this week. We also have a clear break above the March high. So that's a positive. As we've been discussing throughout this pullback, so we've got this round about a 6% pullback that's taken shape. And throughout this pullback, the upward trend has remained in place. There's been no reason to really jump away from the bullish positioning or the upward trending conditions that we've had. Market has remained above these moving averages, the 50 and the 100-day moving averages. And there's really been nothing to suggest that pullback was anything more than a routine pullback within a rising trend. I think the question has really been about how long could a consolidation last for? So my thoughts on this have been that a longer consolidation was likely, just given the extent of the rally off the October low. I think that sort of increased the odds that we got a larger consolidation. But with this new breakout we've had this week to an all-time high, I think that longer consolidation is probably looking less likely. I think the play here, in this current price action, it's very much the same as it was last week, and for that matter, what it's been like for the last couple of months, and that is stay long this upward trend that's been in place and use wide trailing stops to stay on those positions and try and see off the inevitable pullbacks and consolidations that come along the way. The same goes when we go over and have a look at the NASDAQ. So just jumping over to the NASDAQ 100. Again, a new all-time high in the NASDAQ. Trend remains up. And I think this means holding long positions and also importantly is actively looking for new breakouts to buy in the individual stocks. I've got an example for you. I'm going to jump to that in a moment. We'll go and have a look at a current example of a stock breaking out. But look, remember, these markets are never a one-way street. There are always other factors that we need to consider. So it's not a case of just bullish no matter what. Always other things we've got to take into our thinking. And I think this is why we're always managing risk. It's not just about thinking how much could we make, what should we buy. It's about how we manage our risk and make sure we're prepared for when things don't go to plan, when markets do pull back. So the S&P 500 and the NASDAQ, as we've been saying, they've made those new all-time highs. So's the Dow. So what's been interesting is that when you look at the equal weight versions, they haven't made new all-time highs. So let's start with the S&P 500. So this is an S&P 500 equal weight ETF. What's interesting here is whereas the S&P 500 is a new all-time high, the equal weight version hasn't done so. So maybe a new high is coming in the next week or two. That's entirely possible. It could just be a case of big stocks are leading, the others catch up soon. But at the moment, it does set up some divergence where we have new all-time highs in the capitalization, the S&P 500 index, but not so much in the equal weight. Same applies when you look at the NASDAQ 100 equal weight ETF. You got that same divergence playing out. So just something to be aware of. Divergence often disappears. Divergence is an interesting thing. It really stands out when you look in hindsight, but in real time, when you're looking at a market, if this market keeps rising, the divergence will disappear and you'll never notice it again. So maybe this is something. Look, I think it's something to be aware of, but it's not necessarily a big red flag at this time. But as I say, I think it's worth being aware of. We don't want to be oblivious to potential risk, and this is a potential risk. I don't think so much in terms of like a big decline, but just whether there is more backing and filling to do before fold. I'd also like to see these equal weight ETFs make new all-time highs, and then that just confirms the breakouts that we're seeing in the indices. Now, I'm going to show you something else to be aware of in a moment, as well as a stock to keep an eye on. Actually, a stock which is breaking out now, so maybe it's a play that could suit you. But first of all, if you're getting some value from this, please hit that like button, leave a short comment, just, hey, thanks for the video. Just tells YouTube you're watching, engaging. YouTube shows other people. Really helps me a lot, so please do that. Now, I want to show you something else I saw through the week, which I found really interesting. So this is from an analyst I follow, a guy called Charlie Billio, and he puts out a really interesting weekly email. So what this is about the rise of single stock ETFs. So an ETF which holds just one stock. Now you might be thinking, well, what's the point of that? And the point of that is that it's typically a leveraged play. So it's a leveraged version of a single stock. And so just have a look at this. Look at this graph. So this is the amount of money in these single stock ETFs. In third quarter of 2022, there was barely any of them. Quarter four, still barely any. Rose during last year and has really taken off in the first quarter of this year, $7 billion in these single stock ETFs. And one of the examples, prime example, is Nvidia. There's $2 billion sitting in a 2x or a double exposure, a double leveraged Nvidia ETF. And you can see he's got a graph down there. There's the Nvidia 2x and there's regular Nvidia. So all this demand with Nvidia on the rise, people piling in to this 2x ETF. Leverage is great when it's going your way, not so flash when it's not working. But the point I want to make with this is I always just get a little more risk averse when I see things like this. It's that casino mentality when you see it appearing in the stock market. That always does concern me. When people start thinking it's easy, well, as we know through history, they eventually learn the lesson that it's not. So I don't know where this goes in the near term, but one of those things you want to keep in the back of your mind that this stuff is now starting to go on. There are people buying single stock leveraged ETFs. And the play now, I think, look, as I said last week, I think the approach here is to be optimistic, but also maintaining some caution. Just some of those things we just went through. The overall trend's up. We have a market that's trading above rising moving averages, the 50 and the 100-day moving averages. We're trading above those moving averages. And we've also got a market that's finding buying interest on the pullbacks. So that's all positive. I think that's good reason to remain bullish. In terms of buying, I'm looking to buy stocks that are breaking out of ranges, that are rallying off moving averages. And there are plenty of those stocks which are coming out of this pullback, which are doing just that. I'll show you an example. So, and this is one which probably hasn't been on many people's radar for a while. It's the Chinese tech giant Alibaba, and really interesting stock to have a look at. So we just compress this price action, see where it's come from, and it's been a disaster really for the last 3 years. It hasn't been anything you'd want to look at. Trading below declining moving averages, nothing to see here. Move away, do other things. But is that starting to change? So let's just go to the recent price action. We've got a situation where this stock has gone from below the averages to above, and this is the New York Stock Exchange listing that I'm looking at. So below the averages to above, moving average have just started to cross. We've had a sideways consolidation after the initial break above the averages, and just on Wednesday we've seen a strong move higher. Actually, that's Thursday's price action. Thursday's price action, we've seen a strong move higher. I'm going to put a volume study on this, and just look at the volume increase. So we've got a gap higher and a strong upward day on a high volume. That's always an interesting sign when you see that develop. One way this could be, you could play this, would be you're buying at current levels, have a stop loss just below Thursday's low. So that could be a 7% loss, or a little bit larger, maybe 7 to 8, 9% thereabouts. Very much an asymmetric trade, because the upside potential, the upside is significant if it runs. You never know with these things. Not everything runs. It could flop. But these are the sort of setups that I look for, that I like looking for, where you got stocks breaking higher above moving averages and rallying off moving averages. That's where I think the really good opportunities do exist. Now, next video, I'm going to cover the ASX as well as commodities. So you'll see that come up on the screen now. Stay tuned for that. But as for our US markets for this week, I think we will leave it there. So thanks for joining me. Hopefully that's been interesting. Hopefully a few ideas from that. And I look forward to coming back, talking to you next week. Till then, bye for now.